Tech investing in Pakistan is having a banner year. Pakistani startups have raised $82 million in just the first half of 2021, according to data from I2I Ventures, a venture capital fund, or only slightly less than the total amount of venture funding for the preceding 3 years combined. And within that, Fintech has a significant share, accounting for approximately 35 million of the total funding raised so far this year. Among those investments is the current record holder for the largest ever pre-seed fundraising round by a Pakistani startup, the $5.5 million raised by DAG, a neobank. All of that money has been invested on the basis of a simple premise, that Pakistani finance is about to be transformed over the course of the next decade, and that it will be tech startups that serve as a catalyst for that transformation. But this is not a story about who is building what in Pakistani fintech. This is a story that asks one simple question: can the fintech startups displace the banks as a dominant force in Pakistani finance? If yes, how? If not, why not? Farooq Tirmizi investigates. While Pakistanis use conventional offline means of payments as a predominant use of money now, the adoption rates towards electronic money are quite rapid. How rapid? Data from the State Bank of Pakistan is unambiguous on this point. Strip out the internet-based payment systems, which include bank websites, mobile apps, and e-commerce, and the rest of the country's payment systems, which include mostly cash, ATMs, and branch banking. It's grown at just 6.7% per year on an annualized basis between the third quarter of 2016 and the fourth quarter of 2020. Inflation during that period, by the way, averaged at 7.5% per year, meaning the real purchasing power of the non-internet-based payment system went down during that period. What happened to the internet-based payment volume during that period? They went up by an annualized average of 70.1% per year. And when we say internet-based transactions, we mean bank websites, bank and payment provider mobile apps, and credit and debit card transactions on e-commerce websites, excluding cash-on-delivery transactions. This means there is significant growth opportunity for fintech startups in the payment space. Using State Bank data, Profit estimates that approximately 200 trillion rupees worth of transactions take place entirely in cash each, and a significant portion of the remaining 580 trillion rupees worth of transactions also involve at least some level of cash usage. Converting that to electronic means even if a company only earns mere basis points on each transaction, it'll be huge business. It is a neologism in the fintech world that every fintech company claims to not want to be a bank, but wants to become a bank, whether or not they're willing to admit it to themselves. For example, electronic money institutions or EMIs are allowed to not just facilitate money transfers between two parties, but also to store money electronically into their user accounts. Functionally, take deposits. Essentially, EMIs are functionally the same thing as banking, except that it takes place entirely electronically and does not require a physical branch network to function. The problem is that, under current regulations enforced by the State Bank of Pakistan, most of the banking functions I have described are illegal. Paying an interest rate to depositors is outright banned for EMIs. Not only are you not allowed to pay interest to depositors, you can earn less revenue than the bank on any deposits you are miraculously able to attract. You also face transaction limits on just how much money people can move into their digital wallets. By contrast, once you have a biometric verification at a traditional bank, the regulator places virtually no limits on the volume of transactions per month. The State Bank, of course, has a reasonable response. If it allowed EMIs to deliver the same services as the banks, it would functionally be removing the minimum capital requirements it has for the banks, where the minimum paid-up capital starts at rupees 13 billion. If an EMI with a minimum paid-up capital of rupees 200 million is allowed to do all of the same things a bank with a much higher minimum paid-up capital, that would be unfair to the investors of the bank who are asked to risk a lot of money. So what can a fintech startup do? Well, the answer to that question starts by understanding who has power in Pakistani finance now, what they value, and then figuring out a way to get what you need from them without expecting them to give up on any of their core interests. The answer to a lot of those questions are obvious. This is a bank-centric financial system, so it is the big banks that have the power. And they value one thing above all else: their complete dominance of deposit-taking ability. If your startup intends to compete with their ability to take deposits, do not expect cooperation from the banks and do not expect the state bank to be particularly friendly to your lobbying, because the big banks have better lobbyists than you and can rely on very reasonable sounding arguments that all purport to be in the interest of protecting the depositor. By comparison, the path of fintech startups that are focused on lending is somewhat easier. Abhi, for example, is focused on salary advances, a market the banks are currently happy to leave unserved, meaning Abhi has the market almost entirely to itself and is unlikely to encounter resistance. And Finja's small business lending business also does not compete against anything the banks actually want to do. Indeed, the banks are also willing to let fintech startups take that market that Bank Al Habib has provided $10 million in debt capital to Finja to fund that small business lending program. The value of Pakistani fintech will be in covering the vast majority of services that the banks currently do not offer and simply have no interest in offering either. That leaves a tremendous amount of economic value open to fintech startups, and it is entirely conceivable that there will be not one but several fintech companies worth more than the banks. That is not as difficult as one might imagine. The market capitalization of the most valuable bank in Pakistan, Mizan Bank, is just over $1.2 billion. Even as the number will rise over the next decade, it is easy to conceive of more than a few fintech unicorns with their $1 billion plus valuations being higher than those of the mid-tier banks. Will the fintech knight slay the banking dragon? No, but it also does not need to. In their laziness, the banks have left so much open that there is room to grow without confrontation. The financial service sector in Pakistan will offer more services with a greater diversity of players as a result of the rise of fintech players. That is likely to result in profitable growth, with arguably little disruption needed.